We are going to begin the recording for chapter 3 today. We'll go through our normal process of understanding the chapter, going through the various exercises, and then after we've completed that, I will then turn off the recording. For those of you that are still with me, we'll be able to look at exactly what the homework is and the quiz for this week. So I'm gonna just get started here. Now, guys, this is a continuation pretty much of our previous chapter when we talk about job order costing. We're just taking it a little bit further here. And we're going to gain some understanding of how we show the journal entries for the various processes. And then from there, how we go about preparing certain financial statements. So we're going to start by just looking at some terms. We talked about some of these last week. Some of this is a review. And then some of this not. I wish, is there a way I can make this smaller? I'll just leave that alone. Okay, so guys, can everyone see my screen? I'm assuming you can, correct? Yes, okay, thank you guys. Okay, so job order costing. This is what this topic is about. It's a costing system used in situations where you can have different products, jobs, or services, and they're produced each period. So it's a way in which we can figure out the costing of various jobs when several are happening in one period. That is a job order costing. Absorption costing is a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of the product. So this is a way all the costs, not even directly related to the product, but all the costs are absorbed into the product's cost. Next, the term allocation base, which we talked about last week, it's the measure of activity that's used to assign costs to cost objects. Now, usually this is going to be in the form of labor hours or machine hours. It's that measure of activity that then other costs can be assigned to the various jobs. A predetermined overhead rate that we talked about last week is a rate used to charge manufacturing overhead costs to jobs that gets established in advance of the jobs and prior to each period. And basically how we've determined it is we take the estimated total manufacturing overhead cost divided by the estimated total allocation base to come up with a predetermined amount we're going to assign for that cost. Now, overhead application is the process of assigning overhead costs to specific jobs using the following formula. Overhead applied is equal to predetermined overhead rate times the amount of the allocation base incurred by the job. So that's going to be the actual hours, be it labor hours or machine hours, incurred in the job. We did this last week when we allocated the overhead to jobs. Normal costing is a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. And then the job cost sheets, that form we're going to use to keep track of all these costs assigned to a particular job. The direct materials and the direct labor and the manufacturing overhead. So we're going to start with understanding how the costs flow in the job order costing system. And then we're going to prepare the journal entries to show these flows. We know when we manufacture products, we're going to have raw materials that go into the product. We're also going to have work in process, which is the units of production that at the end of the period are not totally complete, but they've begun. So work in process is going to be an account on our balance sheet that is going to be listed as inventory, a current asset, where the units aren't totally done, they're just partially done, and they're going to need further work before they're ready to be finished goods and ready to be sold to the customers. Then we'll learn that finished goods are those units that are totally completed in the manufacturing process, but they just haven't been sold to the customer yet. That's why they are a part of inventory. So the raw materials, the work in process, and finished goods, you will see on the balance sheet as inventory. The cost of goods manufactured includes all the manufacturing costs associated with the goods that were finished during the period. So that cost of goods manufactured is everything that was finished during this period. So the way we see that items flow, various costs, raw materials, labor, and manufacturing overhead are all costs of the product. Those costs are transferred to, as we use them, to the various products that we're completing. Our raw materials go into what we call our raw materials inventory. As we draw those raw material inventory to start products, they get transferred to work in process because those are materials. We've said, okay, we're going to take these now out of raw materials and start making products. As we're making those products, the direct labor that is associated with making those products, along with the manufacturing overhead, gets earmarked or transferred into the work in process inventory while this is occurring. Once the products are completed, then we take it out of our work in process inventory and we transfer it to another category or another, I'm at a loss for words sometimes, and it happens more, into another section, I should say, called finished goods. So it flows. The raw materials flow into work in process as the job is beginning. And as we're working on the job, along with the labor and manufacturing overhead. And then the different section called finished goods will be placed in once the goods are completed, but they have not sold yet. They're ready for sale. Then those goods that have sold will be transferred into the category cost of goods sold, which is an expense on the income statement. Those goods that are still in finished goods, they've been completed, but they have not sold, will be in the finished goods inventory on the balance sheet until those goods sell. Now we know there are product costs and there are period costs. The period costs, such as selling and administrative, do not directly affect the product. So those costs get put expensed right into the income statement during the period in which they had occurred. So we're going to take some different examples and flow this. We're talking concepts. Let's take it into real scenarios. So to illustrate this, we're going to take a company, Ruger Corporation's transactions for the month of April. Ruger produces gold and silver medallions, but in April it only had 2 jobs. Job A is a special minting of 1,000 gold medallions commemorating the invention of motion pictures. It was started during March and completed in April. As of March 31st, the end of the month, Job A had been assigned $30,000 in manufacturing cost, which correspond with Ruger's work in process balance on April 1st of $30,000. So basically what they're saying is the products going in, the labor, the manufacturing overhead, all those costs in work in process as of March 31st, because the job wasn't done until April, had $30,000 sitting against Job A. And Job B was an order for 10,000 silver medallions, and it was started in April and was incomplete at the end of April. So the way we're going to flow the products, the raw material account, we're going to take the direct materials directly associated with this job. They get transferred into work in process. The indirect materials that are indirectly related to this job will flow into manufacturing overhead. So when we purchase raw materials in journal entry form, on April 1st, Ruger had $7,000 in raw materials on hand. During the month, the company purchased on account an additional $60,000 of raw materials. The way we will show that purchase of additional raw materials is to go right into the inventory account raw materials, and we credit our accounts payable. A materials requisition form was prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. These raw materials included $50,000 of direct and $2,000 of indirect materials. Remember, direct materials go directly into work in process. The indirect materials will go into manufacturing overhead. So you see the journal entry that we do shows the direct materials being debited into work in process, the indirect materials being debited into manufacturing overhead, and the entire credit, it's all coming out of raw materials. So we need to reduce the raw materials and increase our work in process and manufacturing overhead inventory accounts. Next, when we record labor costs, the direct labor is going to go into work in process. The indirect labor that is not directly associated with this job will go into manufacturing overhead. In April, the employee time tickets, which provide hourly summaries of each employee's activities throughout the day, included 60,000 recorded for direct labor and 15,000 for indirect labor. As you see, we debit to work in process the direct labor, we debit to manufacturing overhead the indirect labor, and our credit is to salaries and wages payable. So again, the T accounts to show what we're doing here. We're going to take our salaries, debit the direct labor into work in process, debit to manufacturing overhead the indirect labor, and we credit our salaries and wages payable. Now, assume Ruger Corporation incurred some additional factory costs. The utilities in the factory, the rent on the factory equipment, and miscellaneous factory overhead costs all get put into manufacturing overhead. Remember, manufacturing overhead can really be a big total because there are so many costs associated with producing products that, but they're not necessarily linked to one particular job. Again, you see those various items that get put into manufacturing overhead are going to ultimately be applied into the work in process. If the actual and applied manufacturing overhead are not equal, then at the end of the year, we're going to have to do an adjustment to make sure we record appropriately what actually did occur. Remember, the reason we come up with the predetermined overhead rate is because we don't know. And yet we need to be able to charge those costs, hence why we come up with a predetermined. So let's now assume that Ruger Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B for a total of 15,000 machine hours. Thus, 90,000 in overhead cost would be applied to work in process. The following entries record the application of manufacturing overhead to work in process. Since these jobs are in fact being worked on, we're going to take that predetermined rate and transfer it into work in process and credit our manufacturing overhead. Those items that are not part of manufacturing costs get expensed in the current period, like selling and administrative costs. Salary expense of employees who work in a marketing, selling, or administrative capacity get expensed in the period they're incurred, which means it goes right into the income statement. Also, advertising expenses, the same thing happens. So Ruger incurred $30,000 in selling and admin costs during April. We would debit our salaries expense. We credit our salaries and wages payable. Depreciation on office equipment goes right into the income statement. We debit our depreciation expense and we credit our accumulated depreciation. And then those other selling and admin type of costs, again, get put right into the income statement as an expense. advertising for $42,000, administrative expenses for $8,000. Put in there, we can credit either accounts payable or cash, depending on how we handled the payment of those expenses, or if we have not handled the payment yet. So job A was completed during April, but job B was not completed at the end of the month. So the only amount that we're going to transfer into finished goods is job A. So we debit our finished goods for $158,000, and we credit our work in process for $158,000. The portion that was related to job B that's still in work in process, the $72,000 will stay there at the end of April. So this shows you all the work in process gets taken out and goes into finished goods. We won't credit finished goods until the goods are actually sold. Let's say with Ruger, we assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for a total sales revenue of $225,000. Because 1,000 units were produced and the total cost of the job from the job sheet was $158, then we know each gold medallion's cost is $158. Since we only shipped out 750, we need to keep track of what gets put into cost of goods sold, because we didn't sell all 1,000, we only sold $750 units of the 1,000 that were produced. So whenever we sell product, we've got two journal entries. One showing the sale, debit the receivable, or if they paid cash, credit the sales. And then we also need to transfer from finished goods to cost of goods sold at the cost of those goods. So we debit our cost of goods sold, $118,500, and we credit our finished goods. Now, we're going to work on this exercise together. So I want you to kind of think through this. Polaris uses this system. What are we going to do when we purchased raw materials on account for $210,000? Just think about it a minute. Try to write it down, guys. What are we going to do? Aren't we going to debit raw materials for $210,000? And since it was purchased on account, we credit accounts payable for $210,000? Make sense? Then B is raw materials used in production. So it was $190,000. $178,000 were direct materials and $12,000 were indirect materials. Remember, direct materials go into work in process and indirect materials will go into manufacturing overhead. And we credit the raw materials. Does that make sense? Does anyone have questions so far on how we're doing this? Next, I want you guys to take a minute and figure out accrued direct labor cost of $90,000 and indirect labor cost of $110,000. Where are we going to put those? And what are we going to do with depreciation recorded on factory equipment for $40,000? And what are we going to do with other manufacturing overhead costs accrued during October for $70,000? Take a moment, C, D, and E. I'll be right back. I'm just going to pause the recording. So how many of you guys were able to figure that out? Anyone? So basically what we're going to do is put into work in process, debit work in process for the direct materials. For the indirect materials, we're going to debit that into manufacturing overhead. And then we'll credit our salaries and wages payable because they said they were accrued. Our depreciation on factory equipment will go into manufacturing overhead and credit our accumulated depreciation. And then those other costs are going to also be debited to manufacturing overhead and credited to accounts payable. Okay? Then it tells us in F, the company applies manufacturing overhead costs to production using a predetermined rate of $8 per machine hour. A total of 30,000 machine hours were used in October. So 30,000 actual hours times our predetermined rate of $8 will debit our work in process, 240,000, and credit manufacturing overhead of 240,000. So basically what we're doing is we're taking a portion of that manufacturing overhead cost and putting it into work in process. Okay. Jobs costing $520,000 according to their job cost sheets were completed during October and transferred to finished goods. So what we'll do is we'll debit our finished goods of that $520,000 and credit our work in process. Then jobs that had cost $480,000 to complete according to their job cost sheets were shipped to customers during the month. These jobs were sold on account 25% above cost. So if we take the cost of $480,000 times 1.25%, because they're getting marked up 25% of the cost, we will show our cost of goods sold of $480,000. We would credit that against finished goods of $480,000. And then the second portion, the sales portion, will be accounts receivable of $600,000, the $480,000 times 1.25, and we credit our sales for $600,000. So here are the various journal entries you see that went into the manufacturing overhead and then went out of manufacturing overhead into work in process, the F. Do you see that we have $8,000 still that we show over applied? Why do I say over applied? We put more into work in process than we really had in costs here. The costs were $8,000 less than what we applied in manufacturing overhead over here. So we basically over applied our manufacturing overhead to the cost. We don't know We're doing the best guess we can, aren't we? But that's what we did here. Okay, I'm going to give that a minute to you. One sec. Next, we're going to do another problem like this. Does this help, guys? We do these problems so you understand how the flow of costs work. I hope so. Dillon Products manufactures various machined parts to customer specifications. The company uses a job order costing system and applies overhead costs to jobs on the basis of machine hours. At the beginning of the year, the company used a cost formula to estimate that it would incur $4,800,000 in manufacturing overhead costs at an activity level of 240,000 machine hours. Let me just see what someone has to say. Yes, it helps a lot. Oh, good. I'm so glad, Jerusha, it helps. Okay. So the company spent the entire month of January working on a large order for 16,000 custom-made machined parts. The company had no work in process at the beginning of January. And then it shows us these various costs that happened. Raw materials purchased on account, then the raw materials that were transferred into production, labor cost accrued in the factory, how much is direct, how much is indirect, depreciation on the equipment, other manufacturing overhead costs, and then manufacturing overhead cost was applied to the production based on 15,000 direct hours, and then the job was completed. So these are the various steps, just like the other problem. So we're going to prepare the journal entries, we're going to do T accounts, and we're gonna basically figure out how much was included in cost of goods sold. So let's look at these various journal entries. The raw materials purchased from back here, raw materials purchased on account, 325,000. We're going to debit our raw materials, we'll credit our accounts payable. Raw materials used in production. Okay, we're going to debit work in process for the direct materials. We will debit manufacturing overhead for the indirect materials, and the credit will be raw materials of $290,000. The direct labor cost accrued in the factory, the labor cost accrued is 180,000. A third of it is direct, 2/3 of it is indirect. The direct goes into work in process, the indirect goes into manufacturing overhead. Next, depreciation recorded on factory equipment. We debit manufacturing overhead for all of it. We credit accumulated depreciation. Other manufacturing overhead costs incurred on account, 62,000. Again, that's going to be going into manufacturing overhead, we credit our accounts payable. F, manufacturing overhead cost was applied to production on the basis of 15,000 machine hours actually worked during the month. How are we going to figure out that predetermined rate? We're going to take our 4,800,000, divide that by 240,000 machine hours, right? Come up with a predetermined rate, and then multiply that times 15,000 machine hours to come up with how much we put into work in process from manufacturing overhead. So let me just show you this. In this scenario, we went through A. B shows you the direct materials versus the indirect materials. C shows us direct labor versus indirect labor. D shows us the depreciation. E shows us the other manufacturing overhead. And F shows us the amount that gets put into this job, predetermined overhead rates based on direct machine hours. I'll give you this to hold on to for a minute. Okay. This just shows the 4,800,000 divided by the estimated machine hours gives us $20 per machine hour times the actual machine hours gives us the 300,000. So basically, this T account here shows the various numbers going into manufacturing overhead, the various numbers going into work in process. The cost of the completed job is $592,000 as shown. The journal entry would be we debit our finished goods and we would credit our work in process. If 10,000 of the custom-made machine parts are shipped to the customer in February, how much of this job's cost will be included in the cost of goods sold? Well, the cost would be, if we produce 16,000 units, the cost is $37 per unit. So if we shipped 10,000 units at $37 per unit, the amount that's going to go into cost of goods is $370,000. Does that make sense, guys? How you guys doing? Is that clicking? Yes, yes, yes. Good. Okay, I'm glad. Now we're going to move on. We're now going to prepare schedules of what we're going to call cost of goods manufactured, and then we're going to show cost of goods sold along with the income statement. So we're going to use exactly what we've been doing here: direct materials, direct labor, and manufacturing overhead. And the schedules will help determine the cost of raw materials and direct labor used in production and the amount of manufacturing overhead applied to production. The manufacturing costs associated with goods that were finished during the period. So you see here that the raw materials that get purchased during the period are added to raw materials inventory. And then raw materials that get transferred to production is going to be basically the difference between raw materials still in inventory from raw materials available for use in production. The difference is going to be raw materials that were transferred over to production that go into our manufacturing costs. Guys, this is really important that you use this method. Raw material, beginning inventory, plus raw materials purchased are raw materials available for use. Then minus ending raw materials inventory gives us our raw materials used for production. That is how we're going to do it. Okay? Those raw materials used for production go into our manufacturing overhead costs. Okay? Then we've got the direct materials, which we've already talked about. We're going to add our direct labor. We'll add our manufacturing overhead applied to come up with our total manufacturing costs. Okay? Now, the total manufacturing costs are going to be added to our work in process. But we're going to start our work in process with our beginning work in process inventory that began the month. We'll add the manufacturing costs for the month, and that's going to equal our total work in process for the period. Then we will figure out what our ending work in process inventory is to figure out then the cost of goods that have been totally manufactured. So the cost of goods manufactured is added to the beginning finished goods inventory to arrive at cost of goods available for sale. And then the ending finished goods inventory is deducted from this figure to arrive at cost of goods sold. Okay. Okay, guys, beginning raw materials inventory was 32,000. During the month, 276,000 of raw materials was purchased. A count at the end of the month revealed that 28,000 of raw materials was still present. What is the cost of direct materials used? want you guys to, there's 21 of you, 15 of you should at least put an answer in the box. Okay. Okay, who else wants to get in here? There's like 10, there's 21 of you in here. So come on, who else is gonna put up here? Okay. So the answer, you guys are right. We start with the 32,000, we add the 276. Raw materials available, 308, minus our raw materials still present, mean the rest were put into production. That is awesome. Direct materials used in production totaled 280,000. Direct labor was 375,000 and 180,000 of manufacturing overhead was added to production for the month. What were total manufacturing costs incurred for the month? Everyone, I want you to do that. Okay. Oops, wrong one there. All right, guys. This one, B, you guys got it right. We direct materials, direct labor, plus the manufacturing overhead applied gives us total manufacturing cost of $835. Here's another one. Beginning work in process was $125,000. Manufacturing costs added to production for the month were $835,000. There were $200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? Okay, who are we missing here? Connor, Jack Cook, Jackie, Jerusha, Jessica, Kayla, Kirk, Courtney, Kyle, Madeline, McKenna, Nazra, Nathan, Sam, Summer, Zeba. Okay, I got 19 now. We're missing 2. Maybe I'm 1. Okay. Hi, June. I wondered where you were. Okay. So in this case, we're showing the beginning work in process plus the manufacturing cost incurred for the period is the total work in process. Minus our ending inventory gives us our cost of goods that were manufactured of $960,000. Okay, here's our last one. See if we can get 20 of you guys. Beginning finished goods inventory was 130,000. The cost of goods manufactured for the month was 760,000. And the ending finished goods inventory was 150,000. What was the cost of goods sold for the month? Hey, who else, guys? We're missing some people. So the 130 plus the 760 is the 890. Then the ending finished goods, if they're sitting at 150, that means the rest had to be sold of 740. Now, the following data from the just completed year are taken from the accounting records of Mason Company. We're getting all kinds of information. We're going to prepare a schedule of cost of goods manufactured. Assume all raw materials used in production are direct materials. Then we're going to prepare a schedule of cost of goods sold. Assume that the company's over or under applied overhead is closed to cost of goods sold. And then we're going to prepare an income statement. So the first thing we're going to prepare is a schedule of cost of goods manufactured. Where do we begin? We start with our beginning work in process inventory. We add to it, we take the beginning raw materials, add the purchases, showing what's available. If we then have our ending raw materials inventory, the rest goes into materials used in production because they told us all materials will be direct. We add our labor. Then we add our manufacturing overhead applied to work in process to give us our total manufacturing costs added to production. We take the beginning work in process plus the costs added to production to be total cost to account for, less our ending work in process inventory gives us those cost of goods that were manufactured. The cost of goods sold is going to be our beginning finished goods inventory. We add the cost of goods manufactured to give us what's available for sale. If we subtract that finished goods inventory, then we've got our unadjusted cost of goods sold. In this case, we're going to have to subtract what we over applied to overhead. In other words, we estimated too much. We applied too much to our work in process. Therefore, since the actual was 80 and we applied 90, we've got to subtract 10 of the overhead applied to give us our adjusted cost of goods sold of 250. Now we're going to use that cost of goods sold to give us our use in our income statement. Our income statement shows our sales minus our cost of goods sold, gives us our gross margin. Then we have our selling and administrative expenses to give us our net income. Okay. Now, we are going to now learn how we go about computing if it's under applied or if it's over applied, the overhead cost, and how we prepare the journal entry to close that out. So the difference between overhead costs applied to work in process and then the actual overhead costs of a period is what we deem under applied or over applied. Under applied overhead exists when the amount of overhead applied to jobs during the period using that predetermined overhead rate is less than the actual total amount incurred during the period. over applied exists when the amount of overhead applied during jobs is greater than what actually was incurred during the period. So if pair company's actual overhead is $650,000 with a total of 170,000 direct labor hours worked on jobs, and pair had a predetermined rate of $4 per direct labor hour, what that means is we used 680,000 in applying overhead to the jobs. But if the real cost was 650, do you see that we over applied it? Because if the real cost is 650, but we use 680, we've overdone it. We've over applied it by 30,000. So what we need to do is adjust it and subtract 30,000 ultimately from this cost. So if Tiger had actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour, and Tiger had 290,000 machine hours during the period, Tiger's manufacturing overhead is over applied or under applied, and by how much? Put the answer in. Two more. Come on, guys. Who are we missing? Anyone missing? Okay. Okay, do you see it was under applied? 290,000 times $4 an hour means we applied $1,160,000 to the job, cost of goods manufactured. But the real cost was $1,210,000. So we under applied it, which means we need to add this additional cost to the job, or cost of goods manufactured, or cost of goods sold, however we're going to apply it. Any remaining balance in the manufacturing overhead account is disposed of in one of two ways. It can be closed into cost of goods sold, or proportionately, it can be closed into either work in process, finished goods, and cost of goods sold. So in that respect, it's being allocated throughout the jobs sold, the jobs finished, and the jobs still happening. So that 30,000 cost of goods sold shows we are going to add it to our manufacturing overhead and ultimately show it being adjusted into the cost of goods sold. the journal entry in T account form to close out the $30,000 of over applied overhead into cost of goods sold. So this is closing out the over applied, means we're ultimately reducing the cost of goods sold cost. Calculating the allocation of underapplied or overapplied overhead between the work in process, finished goods, and cost of goods sold will happen when they give us the various account balances. Let's assume the overhead applied in ending work in process inventory, ending finished goods inventory, and cost of goods sold inventory is $68,000, $204,000, and $408,000 for a total of $680,000. In that case, we would allocate those balances to the total and apply that amount to the various accounts. So we would take that allocation and apply $3,000 to work in process. We'd apply 30% to finished goods, and we'd apply 60% to cost of goods sold. Okay? So in that case, we'd debit our manufacturing overhead. We would credit the work in process, the finished goods, and the cost of goods sold. So 2 ways of disposing the underapplied or overapplied. You can either close it out to cost of goods sold, or you allocate it between the 3 various accounts, which is considered more accurate. So our last question here, what effect will the overapplied overhead have on net income? If we've overapplied it, what does that mean? We've done too much. Therefore, it's going to ultimately increase our net income because we're reducing our cost of goods sold. Okay, guys, how's everyone doing? We doing okay? So Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. This predetermined rate was based on a cost formula that estimates $218,400 of total manufacturing overhead for an estimated activity level of 12,000 direct labor hours. The company actually incurred $215,000 of manufacturing overhead and 11,500 direct labor hours during the period. Determine the amount of underapplied or overapplied manufacturing overhead for the period. And if it's applied or underapplied goes to cost of goods sold, what's the journal entry? Okay, so it tells us it's using a predetermined rate of $18.20 per direct labor hour. Okay, where the company actually used 11,500 direct labor hours. So the 11,500 direct labor hours at our predetermined rate of $18.20 gives us manufacturing overhead that we applied of $209,300. But if we actually had manufacturing overhead of $215,000, we've underapplied it by $5,700, which means we didn't show as much cost as we should have. Therefore, because manufacturing overhead is underapplied, the journal entry is going to increase our cost of goods sold by $5,700 and ultimately decrease our net income by $5,700. Okay, Harwood Company uses a job order costing system that applies overhead costs to jobs on the basis of machine hours. The company's predetermined overhead rate of $2.40 per machine hour was based on a cost formula that estimates $192,000 of total manufacturing overhead for an estimated activity level of 80,000 machine hours. Assume that during the year, the company works only 75,000 machine hours and incurs the following costs in the manufacturing overhead and work in process accounts. So if we actually use 75,000 machine hours at $2.40, okay? If that's what we actually showed, then we put in $180,000 into the cost of goods manufactured, or I should say work in process here. So what is this? Did we under apply it or did we over apply it? The amount of the manufacturing overhead was under applied by 4,000, which means we actually spent more than we applied. Therefore, we've got to debit our cost of goods sold and credit our manufacturing overhead by 4,000 to break even. When overhead is applied using that predetermined rate, it's assumed that overhead costs are going to be proportional to machine hours. But then when the actual machine hours turn out to be 75,000, the costing system assumes the overhead will be 75,000 machine hours at $2.40 an hour. But this is a drop of $12,000 from the initial estimated manufacturing overhead cost of $192,000. However, the actual manufacturing overhead cost didn't drop by that much. The actual manufacturing overhead cost was $184,000, a drop of $8,000 from the estimate. So the manufacturing overhead didn't decline by the full 12. We're going to talk about this in future. It's the best thing we've got going to help determine this. Okay? Any questions before we move on? Anybody? Good? Yes, 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 yes. Okay. So guys, that's going to end it for our recording.